If wealth grows faster than wages, why does the tax system focus mostly on wages? Here's a question nobody in Washington seems to want to answer directly. If you earn $75,000 a year in the United States, somewhere between 22 and 25 cents of every dollar you make goes to federal income tax, Social Security, and Medicare, before you've paid rent, before you've touched a student loan payment, before you've bought groceries. Now, here's the other number. Elon Musk's net worth as of January 2026 sits at approximately $833 billion, not income, wealth. And in 2025 alone, that figure grew by roughly 22%. That's over $150 billion in a single year. His federal tax bill on that $150 billion in wealth growth? Close to zero, because wealth isn't income. You're only taxed when you sell something, and when you own the company, you generally don't need to sell. That asymmetry between how regular workers are taxed and how extreme wealth actually accumulates is the quiet foundation beneath a very loud political debate that broke open again this week. Senator Bernie Sanders and Representative Khanna introduced the Make Billionaires Pay Their Fair Share Act, a 5% annual wealth tax on every American with a net worth above $1 billion. Not income, net worth, because it touches something most people quietly feel but rarely say out loud. The rules weren't written for you. Let's start where most financial conversations should start. Marcus is 31. He works in logistics management in Columbus, Ohio. He makes $68,000 a year. After federal income tax, state tax, and FICA contributions, he takes home roughly $51,000 annually, about $4,250 a month. His rent for a one-bedroom apartment, $1,350. His car payment on a 5-year-old used Civic, $310. Car insurance, $140. Student loans, he finished a state university degree, $390 a month, 10 years left. Groceries, phone, utilities, internet, roughly $700. Health insurance through his employer takes another $280 from his paycheck before he ever sees it. Total fixed monthly obligations, approximately $3,170. That leaves him with $1,080 a month for everything else. He puts $200 a month into a 401k because his HR department told him to, and his employer matches the first 3%. His net monthly discretionary income after that? $880. Marcus isn't poor. He's not rich. He's exactly where tens of millions of Americans are, running a treadmill that moves just fast enough that falling off feels like a personal failure, not a structural problem. Marcus's older brother has 2 kids, aged 2 and 4. His sister-in-law works part-time as a nurse's aide. Full-day childcare for both children in Columbus costs them approximately $2,400 a month. The Department of Labor's own data puts families spending between 9% and 16% of their median income on full daycare for a single child. When there are 2 children, the math becomes nearly impossible. Marcus's brother has considered whether it even makes financial sense for his wife to keep working. That is not a hypothetical. That is a real calculation happening in real kitchens across the country every single week. This is the ground-level context you need to hold in mind when you hear the numbers in this bill. A 5% annual wealth tax on every American with a net worth above $1 billion. Not income, net worth, the value of everything they own, stock, real estate, private businesses, cash, minus what they owe. As of January 1, 2026, there are 938 American billionaires. Together, they hold approximately $8.2 trillion in wealth. That number has grown 132% in just 6 years. In 2025 alone, collective U.S. billionaire wealth increased 22%. 2 UC Berkeley economists, Emmanuel Says and Gabriel Zucman, ran an analysis of the bill. Even after accounting for a 10% tax avoidance rate, they estimate the tax would generate roughly $368.5 billion per year. Over the 10-year budget window from 2026 to 2037, that's approximately $4.4 trillion. In the first year alone, the bill's sponsors say it would fund a direct payment of $3,000 to every man, woman, and child in households earning $150,000 or less annually. Think about what that actually means for Marcus's brother. 3 people in that household, him, his wife, 2 children. That's $12,000 in a single year. Not a loan, not a credit, a check. Beyond that first-year payment, the remaining revenue would be directed towards reversing $1.1 trillion in Medicaid and ACA cuts that were part of the legislation President Trump signed in July 2025, expanding Medicare to cover dental, vision, and hearing for seniors, building or rehabilitating over 7 million affordable housing units, capping childcare costs for families at no more than 7% of household income, and establishing a $60,000 minimum salary for every public school teacher in America. Now, $60,000 minimum for teachers, that number sounds modest until you know the average teacher salary in Mississippi is under $50,000. In Oklahoma, it was recently under $55,000. This proposal would directly affect hundreds of thousands of educators. The math behind the bill is genuinely significant. Whether it becomes law is an entirely different question, and we'll get to that. Elon Musk, net worth as of early 2026, approximately $833 billion. A one-time 5% tax on that figure equals roughly $42 billion. He'd be left with $791 billion. 1 year's impact? Modest on his scale, but the economists ran a longer calculation. If Musk had paid this 5% annual wealth tax every year since he first became a billionaire in 2012, his estimated net worth at the end of 2025 would have been $363 billion instead of $745 billion. That's still $363 billion, still the wealthiest person on the planet by a significant margin, but it's $382 billion less. Mark Zuckerberg, net worth at the end of 2025, approximately $227 billion. Annual tax owed under this proposal, $11 billion. If the tax had applied every year since he became a billionaire in 2008, his wealth would sit at roughly $90 billion today instead of $227 billion. Jeff Bezos, end of 2025 net worth, $244 billion. Annual tax about $12 billion. But Bezos has been a billionaire since 1999, over 25 years. If the tax had applied throughout that entire period, his wealth today would be approximately $61 billion. These are not people who would be left struggling. They would still own billions, but the gap between their financial reality and everyone else's would be materially and measurably smaller. And here's the aggregate number that frames the whole debate. The 10 wealthiest Americans at the end of 2025 collectively hold approximately $2.56 trillion in net worth. Under this tax, applied retroactively since each became a billionaire, that combined figure drops to $888 billion. Still an incomprehensible amount of money, but the ratio between what they hold and what the rest of the country holds shifts. Whether you think that shift is justice, efficiency, or interference depends on your values, but the arithmetic itself is not in dispute. In the United States, you're taxed on income, wages, dividends, interest, capital gains when you sell something, but you are not taxed on unrealized wealth, on paper gains, on assets you hold but haven't sold. This creates something economists call the buy, borrow, die strategy. It works like this. You own billions in stock. The stock increases in value. You don't sell it, so you pay no tax on the gain. Instead, you borrow against it. Banks will lend to you at very low interest rates because your collateral is so strong. You live off those loans. Loans aren't income, so no income tax. When you die, under current law, your heirs receive those assets with what's called a stepped-up basis, meaning the accumulated capital gains are essentially erased. This is not a loophole in the pejorative sense. It is functioning exactly as the tax code was designed to function. It was written that way. Now compare that to Marcus in Columbus, whose employer withholds taxes from every paycheck before he sees a dollar. The current system taxes labor more heavily than it taxes accumulated capital. And when capital compounds at the rates it has over the last decade, 20%, 28%, 22% in 3 consecutive years for billionaire wealth, the gap between the top and everyone else doesn't just persist, it accelerates. The economists Sayes and Zuckman argue that the proposed wealth tax would narrow the gap between billionaire wealth growth and income gains for average American families, not eliminate it, narrow it. And here's the part that rarely gets discussed clearly. The bill is asking 938 people to pay differently. Not millions, not even thousands. 938 individuals. The entire enforcement apparatus would be targeted, focused, and, supporters argue, manageable. This bill, as currently written, faces obstacles that are both political and constitutional, and understanding those obstacles is part of understanding why the broader debate matters, even if this specific bill never becomes law. First, the political reality. Republicans control both the House and the Senate. They oppose major tax increases on principle, particularly on capital and investment. Even within the Democratic Party, moderate members have historically shown caution about wealth taxes, concerned about their economic impact and their political viability. Bills like this have been introduced before. They generate press, they rarely move. Second, the constitutional question, and this one is genuinely unresolved. The U.S. Constitution limits what's called direct taxes. Under Article 1, direct taxes must be apportioned among the states by population, a requirement that makes certain types of taxes practically impossible to implement. The income tax only became constitutional after the 16th Amendment was ratified in 1913. A wealth tax, applied to net worth rather than income, has never been tested at the federal level. It's not settled that it would survive a constitutional challenge. The Supreme Court had an opportunity to weigh in on related questions in a case called Moore v. United States, which challenged a provision of the 2017 Tax Cuts and Jobs Act. But the court's ruling was narrow. It upheld the specific tax at issue without answering the broader question of whether a tax on unrealized wealth or net worth would be constitutional. That question remains open, and the tax avoidance question, though supporters argue it's manageable, isn't trivial. The bill's mechanism for taxing private business values, illiquid assets, and complex financial structures would require significant new administrative infrastructure at the IRS, which has faced years of budget cuts. On the citizenship question, yes, American billionaires are taxed on worldwide income. The only way to fully escape would be to renounce U.S. citizenship, which triggers a large exit tax under existing law. But the wealthiest individuals have significant resources to structure affairs across jurisdictions in ways that complicate enforcement, even at the federal level. None of this means the idea is wrong. It means the distance between a bill being introduced and it being signed into law is, in this case, very wide. California, which has more billionaire residents than any other state, is considering a 2026 Billionaire Tax Act. It would impose a one-time 5% excise tax on billionaire net worth within the state, potentially raising $100 billion from over 200 California billionaires. The revenue would primarily go to offset federal Medicaid cuts. To get it on the November ballot, supporters need to collect nearly 900,000 signatures. But California's own Democratic governor, Gavin Newsom, himself widely discussed as a future presidential candidate, opposes the measure. He's raised concerns about economic competitiveness and capital flight. In New York, newly elected Mayor Zohran Mamdani has proposed a 2% surtax on annual income above $1 million for the city's highest-earning households, combined with a corporate tax increase to raise approximately $4 billion a year. That revenue would fund universal free early childcare, free bus service, and expanded affordable housing. New York's current city income tax tops out at 3.876%. Mamdani argues that structure is only marginally progressive, given that the top 1% of city earners take home roughly 35% of all city income. Critics Critics warn that millionaires will leave New York. Supporters point to data from Massachusetts, which implemented a millionaire surtax and did not see the mass exodus critics predicted. Governor Kathy Hochul has signaled the New York City proposal is unlikely to get state approval. If it fails, Mamdani has indicated he may turn to real estate tax adjustments instead. What's happening at the state level is, in many ways, a laboratory. These experiments, their successes, failures, and unintended consequences, will shape whether a federal approach ever becomes politically viable. Here's the shift in perspective worth sitting with. Most people, when they hear billionaire tax, immediately sort themselves into one of two camps. Either they think it's overdue justice, or they think it's dangerous socialism. Both reactions move past the thing that actually matters for someone in Marcus's position, or yours. The financially intelligent question isn't whether you personally like Elon Musk or Bernie Sanders. It's this: what does the structure of the tax code tell you about where the system places its weight? Right now, the system places its weight on labor, on wages, on the predictable, taxable, visible income of people who work for a paycheck. It places comparatively little weight on accumulated, compounding capital, particularly while it's still accumulating. That's not an accident. It's not a conspiracy either. It's the result of decades of policy choices made by people who had reasons for making them. Understanding that structure, really understanding it, changes how you think about your own financial decisions. Not dramatically, not with some secret strategy, but in quiet, practical ways. It changes how you think about what assets to build. It changes how you evaluate a salary raise versus an equity stake. It changes how you read tax policy news, not as left versus right, but as a question of where the burden actually lands. The billionaire tax debate won't be resolved this year, probably not this decade. Constitutional questions are slow. Political winds shift. The bill Sanders and Khanna introduced may never pass, in this form, in this Congress, under these conditions. But the underlying question it raises is not going away. Who bears the cost of a functioning society? And is the current answer, where someone earning $68,000 has taxes taken before they see their paycheck, while a $150 billion paper gain goes untaxed, the most rational answer available? That question doesn't require a political position. It just requires clear eyes. The Make Billionaires Pay Their Fair Share Act will almost certainly stall, in committee, in the courts, or both. But the conditions that produced it, 938 people holding $8.2 trillion, while families calculate whether a second income is worth the cost of childcare, those conditions are not theoretical. They are arithmetic. And arithmetic, unlike ideology, doesn't negotiate. Subscribe.